Per usual, loading on this channel is for educational purposes only and is not intended as financial advice. It's Monday, that means it's Macro Monday. Let's take a look at all the usual macro charts and then some. We got regional banks on deck, NVDA at the very end, some inflation components in the middle. We got everything, folks. Give me a like, give me a dislike, whatever. Give me a comment. Help me out with the algo. First things first, though, Bitcoin has continued to sell off on New York Open, largely thanks to cash creates in the ETF, largely thanks to GBTC, ultimately the shenanigans and the consequences of GBTC unloading on us every US session. So thank you, Barry Silbert and friends, for that. Throughout the day, we tend to stabilize, but it seems very clear at this point what's going on. And this is always going to be the number one priority if you're trying to track the flows. This is the first place. Coinbase on the 1 minute through the New York session. Okay, that's where you're going to see what's really going on here. This doesn't look like a net inflows day, but at the end of the day, right, it could end up being a net inflow day. All I'm saying is this is the most important part. Price, not the flows at the end of the day, not necessarily the flows on BTC, but this is where you're going to see it first, right? So clearly we had a large amount of selling after hitting 43 and change once again. Now, yesterday I talked about the DXY headwind. It, in fact, was the thumbnail of that video. I thought it was so important. And DXY continues to look incredibly bullish, which is a headwind for everything. Typically, we don't go in the same direction as DXY on the risk side of things. It's not an impossibility that we follow DXY or are correlated with DXY. It's just unusual to see that. So the more the DXY can calm down a little bit, the better for us on the risk side. The problem is with China kind of imploding in their stock market, it certainly helps the dollar, I think. It helps the dollar that China's potentially printing $1 trillion to shore up their stock market. So it's a little bit of a give and take here. And on the Bitcoin side of things, on the 8-hour, we're still stuck between 42 and 43.5, I guess you could call it. Interestingly enough, looking at the VPVR, the volume of the visible range, we're smack dab in the middle of sort of what you'd expect, right? We had tons of consolidation here in December, and we're right back to that area. So this is definitely, for multiple reasons, the pay attention level. I like that we still have declining volume. I like that we still haven't seen, we haven't seen like a fake out per se. We haven't seen buying volume enough to get us higher. One other line you could add to this already line-laden chart would be some sort of diagonal support maybe. So like I said yesterday, I think we'll see some resolution to that pattern this week for the bulls or the bears. As far as the flows are concerned from James Butterfield, once again, we have a massive inflow week. That's no surprise relative to what we saw on the daily data. But once again, you got to keep in mind, we're still shedding a lot of grayscale stuff. We're moving, sloshing things around, right? This is a giant commercial tanker in the ocean getting thrown around. So you're going to see a lot of very interesting flows data till that settles down. Nevertheless, it's positive, so I'll take that as a win. You can see here another mega outflow week for Grayscale. Thankfully, Fidelity and BlackRock picking up the slack there. Some inflows for Solana, outflows for Ethereum. Now, if Ethereum's getting an ETF, which I think it eventually will, you think those flows would be a little more generous and significant. Also, interestingly, outflows from short Bitcoin as well. And the ETH crowd, like I said yesterday, it is an uphill battle on competition right now based on what I'm seeing with the flows, with on-chain activity, with retail participation. That may change post-halving, but this is not a number you want to see on a week-to-week basis as far as flows on an institutional level. And the rest of everything else kind of, a nothing burger, Cardano, Ripple, Litecoin, 0.000 basically, and multi-asset also quite low. And regionally, United States leading here, as you'd suspect, thanks to the spot ETFs. We do have a bunch of Fed speakers this week. We had Goolsby already speak today on Bloomberg. That's kind of the week, just a bunch of Fed speaks, so get ready for that. The Doves and the Hawks making their case on why they shouldn't raise or should raise in March. Inflation has come down quite a bit on Trueflation, which is great. This is not purchasing power because, this is why people are angry. This is why people are pissed. This is why people are asking, why am I getting less for more? Because purchasing power has been eroded by roughly a quarter. Every day I seem to see something about fast food is more expensive or XYZ is more expensive. noticeably, right? Because we pulled forward an entire decade of that 2% base inflation. On a year-over-year basis, we're down significantly. That's good news. Powell has said he wants to see 3 to 6 months of data headed in the right direction, mainly on PCE. So, as much as there's this focus on CPI, it's kind of not even as important as maybe we think it is. The UK has also made massive inroads to getting their inflation rate down. So we're getting to the point globally where we've certainly gone from a hiking cycle to a cutting cycle, or we're on the verge of a cutting cycle. And within a year, they've gone from 20% to 2% on trueflation, which is great news for them on that side of the pond. The January CPI estimated to be 2.96 by FedNow, which is certainly much lower than the previous CPI print of 3.4. So if I get a print that's 3 plus, that's less bullish for the markets, most likely. If we get a print that is less than 3, closer to 2.9, I would think that would be considerably more bullish, just because that means cuts sooner, most likely. And I don't think we'll see a print above the last month's print. Even the February print is coming in 5 days into the data now, lower again, as we already see with trueflation. So anyway, we're heading in the right direction there. It's really helped that despite the multiple wars going on globally and the issues in the Red Sea, we aren't seeing that with oil at all, right? This is a bearish engulfing candle, a mega bearish engulfing candle last week, assuming this data is correct. Sometimes you have to be careful with trading view on the weekly candles, but that's certainly helping our case on the inflation side of things. We've got wars, we've got OPEC cutting, we've got Red Sea issues, and still oil is unable to make it to 80. Part of the reason is because the United States is just churning out oil at a record rate. And by the way, this whole thing on a technical basis could be a mega head and shoulders pattern. We'll see if this breaks down. The SPR is slowly filling up, right? I'm not going to get too excited about this. But the other question that people need to answer, if you're concerned about the SPR, what is the realistic amount that you expect to be sitting in that thing now that we have production at all-time highs? If you look at the SPR when it originated, our capacity as a country to produce oil was significantly less. But good news there on the inflation front, and we're seeing that on gas prices, which have creeped up a little bit nationally, but on average, still down on a multi-year-over-year basis. Still well above 2021 in the orange there, but good news for anyone who is commuting daily to and from work. Some other inflation components, used car index continues to come down. This was a head and shoulders pattern on a technical basis, and it's following that. So that makes sense there. You can see the pre-pandemic trend again. We're way above that, but that is well on its way lower, which is good news. Here is the freight index, and you're seeing this bump up here, which all the doomers zoomed in on. The Zoomer doomers, they zoomed in on this saying, freight is going to infinity, inflation's going to come back up. It's like these people want things to fail. I don't know. I get it. It's important to see where the risks are. But yes, inflation or freight has come up as far as costs, but it is nowhere near, COVID levels. Still an issue, admittedly, still a problem. Not as bad as you may think based on who's looking at this data set. Housing still very regional, pockets of the country doing better than others. Here's a list from Jeff that regionally, right, some of these are doing terribly. Now, I think DC is a bit of a dark horse. I think it's actually doing in some ways worse than even is listed on here. But this is a mega haircut. And of course, SF is, classically, I think what everybody hears about. People have heard a lot about Chicago, thanks to Ken Griffin moving to Miami. And this is feeding its way through rent prices, feeding its way through inflation. Rent prices in aggregate continue to come down. And just again, kind of anecdotally, I just randomly see DC issues kind of on a weekly basis. And like SF, that's a high crime city that's seemingly getting worse. And like they say here, no signs of slowing. As far as rates are concerned, talked about this yesterday a little bit. Market is not pricing in a cut for March. We've got some data points until that meeting. Again, that's later in the month. So we've got a lot of time for some data to crop up. I don't think weakening inflation is going to be enough for the Fed to want to cut in March. They may come out in March at that time and say the data's good enough now where we don't want real rates to get too high and we're going to start cutting. Powell said yesterday that he wants or expects 3 cuts this year. That's probably going to come before the election. So that gives you 4 meetings for 3 cuts. They may even do a 50 in here somewhere. So I personally think cuts are coming because the Fed doesn't want to be too restrictive. It's not political. It's not because the world is falling apart. It's because we are, called a soft landing or not, we are effectively doing okay, right? Now, there's no reason necessarily to cut, but again, it just depends on how restrictive they want to get. And there's still people coming out here. This is from Marty Bent. I'm not calling him a doomer specifically, but there are still doomers out there who think that something else is going to fail, right? There's got to be a shoe to drop. We can't have tech soaring this high without a reversal. We can't have regional banks not exploding. Like something's going to happen. I don't know when, I don't know why, but something's going to happen. Certainly something could happen, but people still remain fairly certain that we're going to see something. And you're not seeing it in the GDP numbers, which are estimated now at 4.2%. And again, I know people are going to say the numbers are blah, blah, blah. Debt is blah, blah, blah. Okay, look, these are the numbers. I don't know what to say. I'm not going to disagree with you on any of those points, but these are the numbers. So far, so good on the GDP front. If we look at yields, yield spreads, yield curve inversion, also so far, so good in a sense that we are still fairly inverted on the pair that matters, the 10-3. If we look at how it's changed over the past couple of weeks, yields are rising in the, what I believe they call belly of the curve, but still very far from being uninverted just yet. We do have some auctions coming up this week, 10-year, 30-year on the 7th and 8th. We'll see if those are meaningful in any way, impactful in any way in the market, especially in light of the higher for longer Fed. Now, this is the real problem, right? Debt is at 34 trillion. We've issued a record number of treasuries last year, and it's seemingly not going to get any better anytime soon. And it's also unusual that we have the amount of deficit spending that we do prior to a recession, not in a recession in peacetime, right? This is only going to get worse potentially if we do have a recession. There's kind of no way out of this, and this is the problem with the debt spiral that we're in. No one seems to care, right? We just keep spending. 60 billion to Ukraine, 20 billion to Israel, billions for the border, billions for everybody else, and it just, we're just running up the bill. Nobody seems to care. So it's not going to matter till it matters. And again, this is why we Bitcoin. This is why we Bitcoin right here. Looking at the 10-2 yield inversion, still quite far from uninverting. And, employment's kind of a lagging indicator, but so far so good, regardless of how real or unreal those data are. This account, EJ and Tony, he's put together kind of a list of reasons and rationale why the jobs numbers maybe aren't as great as they seem. I won't go through it. I'll leave it in the description of video as a link. But there are certainly issues with the data. Like, there's no denying that as far as what the data are showing. Not that they're wrong. It's just they may not be as rosy as they sound on the initial headline of the 353 number. Nevertheless, regardless of seeing, as I do, as most people do, if you're on Twitter, if you're terminally online like myself, you see these layoff announcements just getting streamed out. And according to the BOA, we're still off our peak. We are rising, right? But we're off our peak as far as job cuts and layoffs. So there's certainly a lot of churn going on between the maybe lower quality jobs that people are getting in gig work or doubling up on multiple jobs versus the more quality jobs that we see people getting laid off from. If we talk about reverse repo and liquidity, reverse repo continues to decline as expected. This is money that is seeking short-term yield via overnight and or short-term treasuries. Now that short-term treasuries have a yield, that's been the preference for the reverse repo slush fund. And this is all sort of lining up to potentially get completely drained by Q2 with the BTFP ending. And we may see liquidity issues. We may see yield spike. That's just something to watch, right? But in the meantime, the party goes on. The music hasn't stopped yet. We still see liquidity being pumped into the system, certainly helping the S&P, helping high yield instruments, Euro kind of going in the opposite direction, and Bitcoin kind of stagnating. Collectively, though, these have roughly correlated since the beginning of 2022 with the rise and fall inversely of reverse repo. And just as a reminder, if we look at high yield credit relative to Bitcoin cycles, taking halving into mind, rising liquidity, rising high yield credit, prices has been bullish for Bitcoin historically, and we're sort of lining up to potentially mirror this cycle once again coming into the next halving. And this can generally just be seen as a favorable risk-on environment. And again, speaking to liquidity, looking at the global liquidity, one of these sticks out like a sore thumb, and that's China. China has continued to try to pump liquidity into the ecosystem. As much as the Fed tries to continue with QT, it hasn't really mattered as much because we are on the other side of that trade with reverse repo dumping into the ecosystem. And just looking at the assets of the central banks, you can see PBOC clearly an outlier, BOJ certainly part of that equation as well. But with the issues that have cropped up in the Chinese stock market, I'd certainly expect liquidity to continue to rise with the PBOC there. And like they've already said, they're calling for huge amounts of money to pump into the ecosystem. They've already disabled shorting, they've disabled selling, and it just hasn't seemed to have helped a lot at the moment. Luckily, on this side of the pond, we haven't really felt that. Maybe Tesla more so than anything else, but it's interesting how siloed these stock markets tend to be at the current moment. But China's going through it right now, right? Looking at long-term yields, TLT continue to be in a bearish, higher time frame trend below the cloud. We saw record volume on a weekly basis for this product last week, which is incredible. Still not that bullish. And this is bearish for regional banks. This is bearish for anybody holding these instruments still. It had quite the run towards the end of last year with yields down, prices up. But as yields go up, prices come down, and we'll know more where this is headed with the bond auction coming up this week. Semi-related to liquidity, if we look at Main Street liquidity, I guess you could call it, and excess savings, which again, I hate that term. It's like hosted wallets. It's just, what's wrong with having excess savings, right? Anyway, we tend to see one of these charts from somebody every week, either calling the end of excess savings or excess savings. This chart is on the excessive side of that, saying that, look, we'll be fine. And you kind of have to figure, where is this information coming from? Not necessarily BOA, but CQ at CNBC tends to lean, let's say, dovish, bullish, maybe leans left politically. And that, I think, bleeds into the type of data anybody highlights on a place like Twitter. Despite the strength we're seeing on the tech stocks, the Metas, the NVIDIAs, in aggregate, equity risk premium, basically rationale buying equities over T-bills, just really isn't there right now. And that is certainly a headwind for anybody else in the ecosystem who isn't part of the top dogs. And that's probably why you're seeing a lack of breadth across the market. You're seeing focus and concentration on the winners, and the losers continue to lose because there's less of a reason to buy these. And to add on top of that, we are looking at a potential refinance risk with these corporate bonds, high yield bonds, investment grade across the board. We're setting ourselves up for, specifically in Q2 with corporate bonds, maybe they issued these at the ZERP levels of rates, and now they're going to have to come to grips with issuing their next set of bonds at a much higher level that maybe doesn't make sense for them or they can't afford. And we may see cracks in the system emerge further. That's the argument anyway, in Q2. So that's something else to watch out for, maybe in the IWM or something that has smaller business focus. But again, as far as the top dogs, look, Meta had its biggest day in the history of any stock market, probably of the world, right? Adding 205 billion. I think it was up 20% on the day. Just massive move in the stock. Certainly a lot of excitement on that product. As far as seasonality goes with the S&P, if we talk about moves following all-time highs, they tend to continue. This is up another, 14% basically when you get a new all-time high after 252 days. So as overbought as everything feels and looks, and the risk for drawdown looks high, this seasonality chart would disagree with that. Something else to consider in the near term from Ryan Dietrich. The fourth year of a new president, we tend to see sort of muted activity until later in the year. It's also something to keep in mind, maybe across the board, but there's a lot of different dynamics at play here, right? Political issues, debt issues, breadth issues, all sorts of problems. And then we've got the regional banks, which, I'm not a doomer, but it's important to know what's going on. and maybe some risks here. So New York Community absorbed Signature Bank. And my read on this is that they, at that point, surpassed capital requirements that they previously had because their assets exceeded some regulatory level. I think it's 100 billion. So now they have to have more reserves on hand, and this stock did not like that. They are down considerably still, and this does not look like it's trying for a bullish reversal here. Now, even though the problem is maybe New York Community Bank specific, if this does go down, you certainly have to watch for contagion for some of the other community banks, regional banks across the country. New York Community Bank, by the way, no small bank by any regard. It is top 50 in the country. This is older data from Q3 2023, but still in the same ballpark. They are top 35 as far as banks in the United States. And it's certainly not a good look to see a bank that absorbed a failed bank to then fail. You know, that's just not a place you want to be as far as bank confidence is concerned. And I looked into their earnings statement. Unlike SVB, who had over 80% uninsured deposits, they have 32%, certainly much lower. Their deposit base is not just VCs, it is diversified, but there's still weakness here that the market is trying to figure out whether or not it's terminal, right? And there are others, smaller, much smaller. This one's been on my radar for weeks, just sort of swirling down the drain here. So it wouldn't surprise me if within the first half of the year, FDIC could get a little busy again. Or maybe Janet makes some phone calls and says, this bank is acquiring this bank. You don't have a choice. You know, that's sometimes how it goes. So definitely watch out for that. I don't think that's going to bleed into the broader market per se, but something like the KRE, certainly not happy with what's going on. NYCB, by the way, is now lower than it was in the SVB regional bank panic. If you look at something like the IWM, which holds 22% financials, you know, that is also something that is probably going to take a hit if we see regional banks start to go down like dominoes. I still like how this chart looks. I like that it's been ranging. I like that it's consolidating near the top of the range. But these smaller businesses, their capital requirements, cost of capital, may be too much to overcome in the nearest of terms. But if we start to see this go higher above 200, that would likely mean rates come down, the maturity wall is less of an issue, and regional banks have stemmed the bleeding. So this is another way just to watch that. Moving on to some other individual names. Tesla also still down more today. Has a death cross on the daily. It's way below the daily cloud. You know, if you're watching trend metrics, I don't think you're surprised. There's a triple top on this as well. I know there are a lot of people who are sort of fanatical about Tesla in ways that maybe Bitcoiners are fanatical about Bitcoin, but overall, this is not a happy chart. You know, this to me looks like it is likely to go lower unless there's some news that helps this reverse. You know, there was rumors that they're going to can Elon Musk. I don't think that's coming, but technicals say eventually this thing probably goes lower. No bull div just yet on RSI. Something else that has been very angry, especially today, it was down over 9% at one point, is Coinbase. And they have earnings coming up in a couple days here, I think next week. This looks to be heavily oversold relative to the highs, back to the inverted head and shoulders breakout point. Cloud doesn't like it here, but at some point, maybe pre-earnings, it makes sense to take a stab here with the assumption that the added volume from the ETFs looks good for earnings on the exchange side as well as the custody side. But this is one that I think is on a lot of people's radars, waiting for the right time to make a move. Maybe that's 110, maybe that's sub 110. I don't think we see 75. You know, if we see 75, that probably means Bitcoin's at 38 or lower, but that's a potential play that's coming up. Marathon's another one. You know, it hit its levels on the multi-month inverted head and shoulder, came way, way down quickly. This is a great advertisement for taking profits in the 1618 fib measured move zone below the daily cloud. This is another one I know a lot of people are watching. Some of these miners are probably better just waiting until after halving to see what shakes out. But this is another chart that doesn't look happy, right? This looks quite bearish. To lose the breakout level, to lose the cloud. This may morph into a double bottom. It may morph into an inverted head and shoulders, but that's got time. So in the moment, certainly not a buy for me. If you look at the listed miners relative to Bitcoin since a point in time, we'll call it early 2022, most of these miners still have failed to break past BTC, despite BTC pulling up quite a bit. I'm not a huge fan of trading the miners over the long term. I think swing trading them is probably fine, right? As we've seen with Riot and Mara and CleanSpark. But I think a buy and hold on those is a tough argument. So I'd definitely be careful in that department. Lastly, NVIDIA. Now, what else can you say? Almost at 700. RSI is at infinity, around 88. At the logical, probably megaphone or whatever this is, ascending, broadening wedge. Resistance, I don't think it's going to matter much. You'll know when NVIDIA's done, because it'll be down some crazy amount. The big tell that this was going higher, that I hope probably a lot of people were watching. I wasn't watching it close enough, but the horizontal at 504. The biggest issue with this chart was it was so noisy, and I don't really see a pattern here from 4 to 500. I don't know what this was or what this is, or what you could call this even. It doesn't look like anything specific, but that was clearly the level where this thing just took off. It's above any measured move target. It's on its way to the 2618 plus. Just incredible move on this. So I'd definitely be careful. You can't short this stuff because the market can stay insane longer than you can stay solvent. So keep that in mind. But I think overall we're still doing okay in the legacy side of things in the United States of America. That's all I have for this one. Like, dislike, comment, share, subscribe, and happy trading.